Hello students, in today's class we'll go through one more example sum on Ind AS 103 business combination. So this is the example given in the CA final study material. Please go through this sum in detail. Yeah, I have given summary of the question here. Let's go through the summary of the question. So in this example, Company X currently holds 30% participating interest in a JV called AWM01, which is engaged in gas producing block, right? And company Y holds 60% and company Z holds remaining 10%. So this is how in the example it has been given. And this AWM01 block, it's an unincorporated JV. It's not a registered company, it's kind of unincorporated setup they have. And for this JV, company Y is the main operator and company X and company Z are joint operators, right? So that's how it has been given. And all the expenses of this JV initially paid by company Y, and at every month end it has been given that on prorated basis based on the investment from X and Z, company Y used to raise invoice for the monthly expenses, and the company X and company Z are supposed to make payment to company Y for their share of expenses. Okay, and the machineries and manpowers are owned by the JV as per their stake. And company Z could not pay dues to company Y. So this is important. So company Z supposed to make payment for their share of expenses to company Y, but due to their treasury issues, they could not make payment to company Y. And then it seems it has been given the sums that they went into some kind of litigation and finally got concluded that company Z will be taken over both by company Y and company X. So company Y will take over 67% stake of company Z, and company X will take over remaining 33% stake of company Z, right? But in this example they talk more about company X taking over company Z, and for this 33% stake the purchase consideration is fixed at 1 lakh, which means company X will pay 1 lakh rupees to company Z to buy this 33% stake. Okay, so that's given. And since it's kind of a natural resource extraction, it needs the government of India approval, and this approval has been obtained on 30th June 2021. Okay, and also it's given that company is in the balance sheet they have a PPE, property plant and equipment, and the CWIP. So PPE has been revalued, or it has a fair value of 5 lakh rupees, and the construction work in progress, it has a fair value of 2 lakh rupees, and all the other remaining assets and liabilities, the fair value and carrying value are the same. Okay, and as part of this accusation, only the current assets, current liability, non-current assets, non-current liability will be taken over, excluding cash. Okay, and the tax rate has been given at 30%. Okay, so now we are required to prepare whether this accusation falls under business or asset accusation as defined under the business combination standard in AS 103. So we'll have to see with the given information whether this accusation will be a business combination or a mere asset accusation as per the definitions under Ind AS 103. Done. And also we have to determine the accusation date, and then we have to prepare some journal entries for the merger, and then we'll have to prepare the final balance sheet of company X once the merger took place. Done. Okay, let's see how this can be done. So let's get into answer. So as a first step, we have to confirm whether this accusation falls under business combination or asset accusation as per Ind AS 103. So let's go through. So for this we need to refer what is the definition of business under Ind AS 103 and what is the definition of business combination under Ind AS 103. Right, okay, so we'll go through what is the definition of business under Ind AS 103. So this is a bit important. You'll have to remember this definition. This is very critical. So business is defined under Ind AS 103 as an integrated set of activities and assets and liabilities. So it should be an integrated set of activities clubbed with assets and liabilities that is capable, that business should be capable of being conducted and managed for the purpose of providing goods or services to its customers. So there should be activity and there should be assets and liability, and together it should be capable of being conducted and managed for the purpose of providing certain goods or services to its customer. And why this should be done? In order to generate a kind of either investment income or to generate other income from ordinary activities. So the investment income could be dividend or interest, or other operating income could be the operating profit from those business. So if all these conditions are satisfied, then it will be qualified as business, otherwise it is not. Okay, so this is how business has been defined. And now let's go through what is the definition of business combination. Okay, so here the entity must gain control. So this is important. The entity must gain control. If it has to qualify for business combination, the control should be transferred, and so the control should be on the integrated set of assets and the activities, which means the business. So it should be the control of business should be transferred, and that's more than a collection of assets. So if it is just collection of assets, you will just identify certain assets, you pay and buy the assets. But it should be more than collection of assets. It should be a integrated set of assets and activities that should be taken over. The control should be taken over. Okay, so this essentially requires two items. One, the input and the process. So the set of activities means the input and process. So the control on input, the control on process needs to be taken over. And by taking over the control on input and control on process, eventually it takes over the ability to create the output. So it means the running business being taken over. Okay, so now let's analyze facts from the given question. So here X acquired the participating rights from company Z. Okay, and the accusation includes input because it has been given that the specialized expert manpower and machineries are part of the JV and a share of JV is being taken over. So we can conclude there are inputs, and there exists a manufacturing process as well because the mining activities being taken over. Development and exploration of gas activity would be a process. So we can also conclude there is a process. Okay, so with this finally we can conclude that this accusation is a business combination under Ind AS 103 because there is business, the control of the business being taken over from company Z to company X. So we can conclude this is business combination under Ind AS 103. Okay, now let's go to next step, which is a determination of accusation date. Okay, so as per you will have to refer the para 8 of Ind AS 103. So as per this para, accusation date is the date on which the acquirer acquires control. Okay, so the date on which the acquirer acquires control is the date on which on which the accusation happens. So here it has been given that on 30th June 2021, Government of India has given the final approval, and it has been given that without Government of India approval, these transactions cannot be taken through. Okay, so since it's a critical approval, so we can take the date on which the Government of India has approved is the date on which the control has been transferred. Okay, so this 30 June 2021 will be the accusation date for this example. Okay, now let's go through third step, See, here we have to analyze company Z, because company Z balance sheet partially being taken over by company X. So we'll have to understand and analyze the balance sheet of company Z and then work out the portion which is being taken over by company X. Okay, so first we'll just take, it has been given what is the balance sheet of company Z as of 30 June 2021. So that we'll plot here. And then the stake which is being taken over by company X is 33%. So we'll apply 33% of all those assets and liabilities and see what is the carrying value of the balance sheet of company Z being taken over by company X. Okay, so this is first step, and we'll have to work out what is the acquisition date value. They have also given the fair value of certain assets. So let's take what is the fair value of those assets being taken over. I mean the ratio or 33% of the fair value of the assets, how much being taken over by company X. That we'll try to fill in this column, and here we have given some working on how those fair value ratio have been worked out. Okay, so you can see PPE, the total value as per balance sheet is 300,000, and 33.33% of this 300,000 is 99,990. So the carrying value of the assets being taken over by company X is 99,990, and they have given the fair value of those PPE. I can go to this note. The fair value of PPE is given as 500,000, and 33.33% share to company X would be 166,650. So that is this 166,650 has been put here. Right. So similarly, you can see all other assets as well. So I'll go to the CWIP. So 100,000 is the book value. So 33.33% comes to 33,330, which is a carrying value allocated to company X. But in terms of fair value, it has been given that the CWIP, the total fair value is 200,000. So 33.33% of the fair value comes to 66,660. So that's the value we have mentioned here, right? So all the other assets, it's just a mere ratio. We have taken the full assets value and 33.33%, and the took over value is also equal to carrying value. Done. So let's make this first, and then then we'll see how the goodwill or the bargain purchase needs to be calculated. Okay, so here we'll take this 33.33% of all the assets taken over by company X. So this is the value of non-current assets. I mean, this is based on the fair value, and this is the value of all the current assets, and this is the non-current liability, and this is the current liability. And we'll have to work out the deferred tax. So let's go through the next working on how this deferred tax needs to be calculated. So finally 119,988 is the net assets being acquired. So to acquire this 119,988, the consideration paid is only 100,000, which means they take over more assets than what they pay. So this gets into gain on the bargain purchase. Okay, to be transferred to other comprehensive income. That value comes to 19,988. Okay, so now the only thing left is how to calculate the deferred tax liability. So for this, let's go through. This is also similar working. So we'll take all the non-current assets value at fair value, and the current assets value, and then non-current liability and current liability, and then determine the net assets being taken over at fair value. That comes to 1,49,985. Okay, and then so this is the fair value. To calculate deferred tax liability, we have to see what is the book value. So basically, book value, we assume it's equal to tax value. So that comes to 49,995 as per the balance sheet. Okay, so difference between these two are the temporary difference. On this, we will have to apply the tax rate, which is given at 30%. So 30% of the temporary difference comes to 29,997. So this is the deferred tax liability we have to create. Okay. So this deferred tax liability means you have the more fair value than the book value. So difference between these two, you have to pay tax over the period of time. So when those income actually becomes realized, so that's why, since you have the future tax liability, it's called as a deferred tax liability. Okay, so that deferred tax liability we have put here 29,987, and then finally the bargain purchase value have been determined at 19,988. Okay, then finally we'll have to make some journal entries on how to do the merger. So these are the value of company Z being taken over by company X. So we'll have to debit the standard value or the fair value of PPE, and then all the proportionate assets being taken over we have to debit, and then all the liabilities taken over we have to give credit. So the provision, all the 33.33% of the carrying value of the liability we have to give credit, and deferred tax liability also we have to give credit, and 100,000 is the consideration paid, so we'll have to give credit to cash 100,000, and then this 19,988 is the gain on bargain purchase needs to be credited. So these are the journal entries we have to pass for the merger. So once these journal entries have been passed, we can plot the combined balance sheet. So combined balance sheet of X along with prorated portion 33.33% from company Z. The balance sheet will look like this. So this is a pre-acquisition balance sheet of company X as of 30 June 2021. It has been given, so no adjustment here. And here these are the adjustments. So these are the adjustments based out of the journal entry we have just referred. So all the journal entries have been plotted here, and on the post acquisition we'll have to just add the pre-acquisition plus these adjustments. So that will give total assets of 25,16,636 for the combined balance sheet, and liability also 25,16,635. Okay, so this is how the combined balance sheet needs to be made. Okay, so with this I will conclude today's class. So if you have any doubts or comments, please feel free to add comments in the chat. Thank you.